Welcome to Yahoo Finance this Wednesday, July 31st. I'm Julie Hyman. Miles Udland sitting right here next to me, and we are moments away from the Fed's decision on interest rates. Let's get a check on what's going on in stocks ahead of that. And we are seeing a rally here across the board, particularly strong in technology. The Dow, though, is also up. It's up about 264 points. That's about 2/3 of 1%. The S&P up 1.5%. And the NASDAQ roaring back from some recent losses with a gain of about 2.3%. Does that put us on more delicate footing, perhaps, going into what is widely expected to be no move from the Fed? And then a lot of debate about how clearly that Jay Powell and company might signal that a cut is coming in September.
You know, this Fed meeting, Julie, every year falls right in the midst of the big tech earnings that we have this week. You know, a third of the S&P is reporting. And sure, we're on a different time, so maybe that throws off my rhythm getting ready for this. But I was thinking, we're going to talk about Nvidia, right? Jay Powell, it's Nvidia, right? It feels like the market today, because there's that, 97% view that we're going to get no cut today. It's all about September, all in the signaling. How do they change this statement? There's really a sense that, this Fed meeting is one for markets to kind of survive in advance. Let's see what happens. Let's get through Meta tonight. Let's see what Amazon, and Apple have to say tomorrow. And then we can reassess as we get to next month, because I think, we chatted about it this morning. We're going to get through today. Jackson Hole might even be a bigger event than Powell's press conference in about a half hour. And then we'll get to the real show for the Fed in September.
And there's also still a lot of economic data, big economic data between now and that Fed
reports,
September. A couple jobs reports, more inflation data, and then Jackson Hole happens at the end of August, and traditionally is a place where the Fed can give more signals about what is coming next. So indeed, a lot to happen between now and then. But in the meantime, stocks are up, so we'll see what that means in terms of the setup. Well, the Fed's July decision out. Yahoo Finance's Jennifer Schonberger has details.
No change. The Federal Reserve holding rates steady in the range of 5.25% to 5.5%, but stressing that officials see progress towards their inflation goal, hinting that they are drawing nearer to a rate cut. The committee changed language in the statement to say that in recent months, there has been, quote, some further progress toward the committee's 2% inflation goal. That's a change from, quote, modest further progress in the prior statement. They also noted risks to both sides of the dual mandate, inflation and full employment, quote, continue to move into better balance versus moved toward better balance in the prior statement, meaning that now the Fed sees the risks to both the employment and inflation sides of its mandate more equally weighted, whereas before they saw more risk to the inflation side. They say, quote, the outlook is uncertain and the committee is attentive to the risks to both sides of its dual mandate. Though officials maintained key language in that statement that they have held since January that, quote, the committee does not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably towards 2%. The central bank reiterated that inflation is eased over the past year, but characterized it as, quote, somewhat elevated as opposed to just elevated. Officials also noted that job gains have moderated and that while the unemployment rate has moved higher, it remains, quote, low. The decision was unanimous. However, Austin Goolsbee from the Chicago Fed filled in for Loretta Mester from the Cleveland Fed since she retired in June, and there's no replacement at this time. Back to you.
Jennifer, thank you very much. So largely as expected here in terms of no change, but also it did seem like there was a little bit of inching towards that loosening of language that might indicate a little bit more decisiveness for September. But Miles, obviously in the press conference, we'll see if we get more nuance on that front.
Yeah, it's nice that we get the press conference. You, of course, remember when we used to have this meeting come and go with no commentary from the Fed, the Fed chair at that time. So I think the word coming out of the statement that stands out to me is somewhat. And Jennifer called it out, where you have inflation remains somewhat elevated, a change from calling inflation elevated. So they kept the language around needing greater confidence on inflation readings to adjust their policy stance. I think that gives the Fed plenty of wiggle room with the July, coming next month CPI report, and then the August CPI report coming in September ahead of the Fed's next meeting. So you have two inflation readings there, plus a couple of PCEs mixed in that you can go to and say, all right, that's the confidence we need. But taking away that idea of inflation being elevated and calling it somewhat elevated is really, to my quick reading here on the desk, the most important change within that statement that, again, is opening that door that I think the Fed wants to walk itself through in 6 weeks.
Yeah, and we want to go back to Jennifer Schonberger now to see what else you want to flag from the statement or the interpretation of it, Jen.
Thanks, Julie. Just building on what you guys were just talking about there, the Fed had really a range of things they could do here. And what they ended up doing is just cracking the door open as opposed to swinging the door wide open, right? And I think to the prior person's comments that they said the characterized inflation is somewhat elevated says that they have seen progress on inflation, but they don't have enough of it yet to fully set the table for that rate cut in September. This signals to me that there's a lot of room between now and September where things could change, and they do not want to tie their hands. They want to make sure that the data continues to show progress for July and August. If we're seeing better data that come in line with what they want to see by the time we get to Jackson Hole, then Fed Chair Powell can really lay the groundwork. But to me, this is not a wide open, hey, yeah, we're doing it. They're saying we're cracking the door open at this point.
All right, Jen Schonberger, we'll stick with you as we get through the press conference here. We'll hear from you on the other side. For more on how markets are reacting, let's go to Yahoo Finance's Jared Blickery, who is standing by at the Wi-Fi interactive touchscreen. Jared.
Miles, you will see a lot of green behind me, but this was the state of affairs just a few minutes ago before the announcement. And I will show you a picture of the NASDAQ composite. Virtually no movement off of that 2 p.m. release. And that's probably a good thing. You know, investors are sitting on some nice gains for the day, had a rocky month, violent restructuring, violent a rotation in people's portfolios, but here we are. We're seeing the NASDAQ up over 2%. And let's get a read on the bond market. The initial move, there was just a small move down. Now, what this means, these are Treasury futures, so these move inversely to yields. That means that yields are a bit elevated right now after the report, but we're not talking a lot here. These are just very small movements, and that is the 10-year T-note yield futures. Now, here are gold futures. Those are just ticking down just ever so slightly from that 2 p.m. mark, but you can see still up 7/10 of 1% for the day. And then let me also get a check on the dollar. This is going to be the euro versus a dollar, and not a whole lot of movement there either. So I can go to Bitcoin, but I think the story is going to be the same. We really have to wait 25 more minutes until Powell takes that lectern and starts talking about some of the future moves that the Fed might make, especially looking to September. I would also note that this Friday, we got a big payroll report. We might get the SOM rule triggered if unemployment hits 4.2%. Guys?
That is an excellent reminder. Thank you, Jared. Appreciate it. Well, for more on the Federal Reserve's latest decision to hold rates steady, we want to welcome in Stephen Whiting, Citi Wealth Interim Chief Investment Officer. Steve, it's great to see you, as always, to get your thoughts on this. I want to pick up a little bit on what Jared was just talking about, which is that the Fed now sees the risks as more balanced, meaning the risk of inflation a little bit lower, but the risk to the labor market perhaps a little bit higher. And so I'm curious how you're thinking about that balance.
I think it's pretty clear that the labor market is decelerating. And if you want a story of collapse, you're not going to get one. But we've had a very large drop in unfilled job openings, about 4 million. The pace of employment gains, if you take a look at the second quarter, 146,000 for private sector employment, it's the weakest of the post-pandemic recovery thus far. If you take a look at the downward revisions that we've seen for 12 months, they've averaged 33,000 for non-farm payroll revisions. So what's happening in every likelihood is when you see Friday's payroll report, it's an overstatement of the actual strength. So things like the narrowing of the breadth of employment gains that Fed Chairman Powell cited at his last press conference, FOMC press conference, was pretty critical for, do they really want a 5.5% funds rate in that environment where you're decelerating on inflation and employment?
Stephen, I'm curious how you thought about I want to say a groundswell, but certainly more and more folks in the last few days discussing the notion that maybe the Fed should have just gone ahead and cut rates today rather than waiting for September, which is what markets have clearly priced in. Did that ever seem realistic to you? And I guess the question would also be, are markets already doing the Fed's job for them? The cut might be academic by the time we get to that September meeting.
Well, certainly markets are leading the way, but they're also interacting with Fed speak. So pretty clearly here, if the committee had come up and said, well, this is just unacceptable unacceptable. We need to act soon. Markets would have been priced for it. So what we see when you actually get to Fed Day is, generally speaking, you get more than a 90% hit ratio of no surprise. We take a look back through the history since around 1994. You would have seen that markets are pretty well braced for what the Fed actually does. And this is a case, again, where they're not seeing sort of any emergency action here. The press release, what you just saw ahead of Powell's actual comments, it's really about why they held rates steady today, not how their outlook for monetary policy evolves. Let's just remember their last summer of economic projections for a little more than 2 years from now, they have policy rate at 3.1. So, their outlook to keep the economy from having an unacceptable period of labor market weakness is one in which they're easing monetary policy. I think Powell, in a short while, will probably explain to the broader public that this isn't just about recession or boom, that this is really, again, that we've set monetary policy restrictive, and we have to ease back from that if we want to keep to a very full maximum employment situation.
I want to dig into employment a little bit more here, Stephen, because we've gotten some more economic data this week on the job front. We got the JOLT survey, which showed the quits rate ticking down, right? We're, of course, getting the full jobs report on Friday. But, now that we have this gap between this meeting and the September meeting, how do you think about the idea, the possibility, the risk that we would see a more rapid worsening in the labor market between now and then?
So look, I don't believe that the economy has built up a lot of vulnerabilities. We reacted to a lot of stimulus in the last couple of years. We've had tremendous upheaval and demand related to the pandemic, the rebound from that. But by and large, we haven't overproduced or overhired. Some of the strange things that have happened in the last couple of years, long lag that we had between the initial turning point, the recovery from the pandemic, and a full rebound in services hiring, where most of the headcount is, sort of masked a lot of weakness in other areas. And that's one of the things that I think is unusual for this period. But it's not as if we have such an incredibly strong labor market. We're overproducing the demand. We're about to just have the rug pulled out from under us. So I don't think that that's going to happen. But I do think, again, that the description that the Fed has provided, that monetary policy is restrictive and that it's going to interact with the labor market, that if we kept policy rates at 5.5% and you tick down from 6 million to 3 million to 1 million gain for a year in employment, effectively monetary policy, again, is really going to take us to a place that we don't want to be in the labor market eventually. Now, that I do think is right. And that's why, again, maybe they have a little bit of time here. Committee dynamics, convincing everyone that inflation's backward looking. Look, maybe it's going to take a little bit more time. That's how I would assess where Powell will be in a few minutes.
Yeah, and Stephen, I'll get you out of here on this, just thinking about the Fed, maybe as we get to 2025. I mean, is this a new era for the Fed in terms of trying to explain, I guess, kind of like a strong cut? It rarely happens that you're cutting rates in an economic situation that you're actually happy with as a Federal Reserve, but it seems to be the case that we are embarking on that kind of a cycle. At least the Powell Fed believes that we are.
Well, look, I think that they're thinking of this as a mid-1990s adjustment, maybe without all the optimism that we saw that followed, which is really, again, a different story. We have our own interesting productivity stories. You were talking about earnings earlier. But really, this is just about moderating monetary policy. In 10 of the last 11 easing cycles, the Federal Reserve has begun cutting interest rates while employment growth was still positive. Now, if they were going to be doing 50 basis point cuts, the kind of environment that typically gets them there is when they've gone too late, when they have a contraction in the economy, a self-reinforcing contraction where the strong industries are going to go down with the weak ones in a recession. So I usually don't take monetary easing as a positive catalyst for the economy. I think in this particular case, they can say that, look, they caught up with inflation, they went to a restrictive setting, and that the path forward is one of decelerating inflation, a decelerating job market. We have to be fortunate here as investors is that this is kind of the mirror opposite of 2022. Back then, we had a really strong labor market, and the Federal Reserve was reacting to that, and profits were weak for a good year and a half. So this time around, the Federal Reserve is in all likelihood going to be able to take monetary policy, move it out of this restrictive zone. And again, it's a forecast. Something could come along. We're more vulnerable to shocks now with tight monetary policy.
Well, fingers crossed here, Steve. Good to talk to you. Thanks a lot.
My pleasure.
Well, stocks are holding on to gains after the Federal Reserve decision. We'll see if it stays that way as investors wait on Chair Jay Powell's news conference. We've got more analysis on the other side. The Federal Reserve keeping rates unchanged, but the FOMC acknowledging some softness in the labor market. Joining us now, Greg Dacco, EY Chief Economist, and Jeff Klingelhofer, Co-Head of Investments and Portfolio Manager at Thornburg Investment Management. Greg, I want to get to you first here, and thank you both for joining us. Let's talk about this new balance of risks here. In addition to the JOLTS report, we also got ADP this morning, and again, both showing, under the surface, some signs of labor market weakening. Do you think that the Fed is acknowledging that enough?
I think this is still a bit of a too shy of a wink-wink in terms of a potential rate cut in September. The Fed remains, in my opinion, too data-dependent and backward-looking in that regard. You've heard me talk about this in the past, but I still feel like we should have more of a forward-looking perspective. If you look at the totality of data, you're seeing employment gains slow. You're seeing the unemployment rate tick up. You're seeing the JOLTS report, as you were referring to, indicating slower quits, slower hiring, slower job openings. Overall, the labor market is slowing, and inflation continues to move towards 2%. So we're in the environment that would require the Fed to start recalibrating monetary policy. I think it's pretty simple for Fed policymakers, but they're still erring on the side of caution, being, in my opinion, way too backward-looking in their assessment of economic conditions.
Now, Jeff, as I read your notes to us, I think you're a little more comfortable with the Fed maybe slow walking its process as we get towards September. And I guess as we've seen the markets, really aggressively decide September is going to be it. The Fed, we'll see how Powell kind of handles that in the next 15 minutes or so. But I'm just curious how you see the landscape and kind of what you think the Fed not only should be doing here, but really needs to do to keep the economy either in the place that it wants to be, or perhaps doesn't risk it getting into a vulnerable situation.
Yeah, I mean, as I read the Fed statement, I think the Fed did exactly what they were supposed to today. The market is a little bit too ebullient in terms of its belief that we are 100% priced for a move in September. And the reality is, there are better balance of risks. Inflation is coming down, but it's not this immaculate disinflation story. It's coming alongside with a weakening economy. My main contention is the Fed shouldn't be necessarily forward-looking because nobody has a crystal ball. I think the goal of monetary policy is to cushion a cycle, but not try to engineer a cycle. And the reality is the job market remains relatively strong, although weaker than it has been, and inflation remains elevated above its own 2% inflation mandate. So I think the Fed is appropriately on hold here. And I hope that what we see from Chairman Powell in the press conference is doubling down on needing to see more data that they are absolutely moving towards that 2% inflation objective. And I think we remain a relatively far ways away from having true confidence.
Greg, game it out for me. What would it look like if the Fed did nothing the rest of the year? I mean, obviously there's changing economic conditions, yada, yada. But if you had to say today and game it out what that would look like, what would you see?
Well, I think if we fast forward to the end of the year or potentially next year, we're going to be in an environment where you're going to see ongoing disinflation and a rebalanced labor market for which any further weakness would portend to slower income growth and a potential more significant pullback in consumer spending activity. You're already seeing businesses become more cautious. You're seeing signs of a slowdown in economic activity. If you have a higher for longer scenario, where the Fed does not start to ease monetary policy, you're going to see a tightening of financial conditions. Combine that with an environment where there's increased focus on the fiscal situation in the US with elevated levels of debt, high interest debt payments, that could portend to a negative feedback cycle where interest rates actually rise further from here, and that leads to a more pronounced pullback in private sector activity. I really believe that the Fed needs to be much more forward-looking, and I wouldn't be surprised that Fed Chair Powell, in his introductory remarks, talks about that greater confidence in the move towards 2%, and perhaps even signals in his press conference responses that there is openness to a potential rate cut in September.
Jeff, given I think where the market saw the Fed headed, really we came on the air and we're talking about the action today is Nvidia. So looking at that rotation, look at what's happened kind of in the NASDAQ and elsewhere. I'm curious how you've looked at, not just the reaction to Powell or to the Fed statement today, which was not much of a reaction, but what we've seen in markets over the last couple of weeks is I think investors start to really grapple with this next phase of the cycle. And we can debate all day whether they should go now, November, et cetera, but we've seen markets really start to change their behavior. I'm curious how you've thought about that.
Yeah, I don't think it's really connected to the cutting cycle or potential cutting cycle of the Federal Reserve. I really think it's just markets got far too ahead of themselves of pricing in the significant growth runway of AI. And what we've told clients for some time is absolutely AI is very likely to change the world, but it's not going to change the world today. And I think over earnings reports and companies we talk to, what we haven't seen is a transition from the build out to actual use cases. And so the risk to that is maybe the build out is a little bit slower and some of those estimates of forward growth have to come down. But on the flip side of that rotation is the significant move we've seen in small cap stocks, and that is premised on a belief from markets that the underlying economy remains incredibly, incredibly strong, because it's small caps that should sell off, should face the most pain if the economy truly does weaken. And so I think the Fed is really, it's the uncertainty. It's the uncertainty of if we're heading into any potential slowdown, how deep that slowdown will be, also, and if inflation continues to come down, and the Fed should stay pat, but that underlying rotation, we, the markets, are paid to take forward-looking views. I think the Fed isn't.
All right, we'll leave it there. Jeff, Greg, thank you both for the time on this Fed Day. So again, Fed leaving rates unchanged at its July meeting. We are about 8 minutes away from Fed Chair Jay Powell taking to the podium for a press conference, talking to investors and to the media. Let's bring in former Atlanta Fed President Dennis Lockhart to talk more about the task ahead of Chair Powell. And Dennis, I was thinking back to your time at the Atlanta Fed. They only had press conferences 4 times a year when I began covering the Fed. I'm not sure if they had regular press conferences at all back when you took that post. It's a different era for Powell now. How do you think the chair is approaching, this moment, and how, I guess, really he's approached this whole cycle, knowing how often he is able to speak to markets to get them to where maybe he's more comfortable, with their pricing?
Well, I think one thing to keep in mind about this press conference is he has Jackson Hole coming up, and that gives him an opportunity to lay out a picture, if he chooses to do so, in a very comprehensive, very measured way. So he may not feel he has to say too much, even if the committee in the meeting today is leaning toward a September move. I'll also say that in my experience, it's hard in one meeting to talk about what you're going to do in the next meeting. And so it's quite possible the committee just really didn't form any kind of a view of regarding September.
And I guess especially at a meeting when the next one is pretty far out, right? It's not a close-in meeting. It's not until September. So given that, how do you expect Jackson Hole to be used by the Fed chair? Do you think that maybe by that point, he'll have a higher degree of comfort about being more clear with the signaling for September?
Boy, that's a really tough question because the chair can do a variety of things with the Jackson Hole speech. Can say nothing, can say a lot, can speak strategically or in terms of framework, or can really talk about relatively near-term monetary policy. Powell has described this next decision as really a momentous decision, a major decision. He may wish to, because of where the committee is at this time, not address that, but maybe talk in terms of the history we've seen since March of 2020 and the pandemic crisis hit. I really can't predict. It is a speech that has been in preparation for some time, and these speeches tend to be big picture, fairly comprehensive in trying to lay out a logic of some kind.
And I guess in thinking then maybe about the balance of the committee, those other 17 members over the next several weeks, how much consensus do you think those folks are likely to congeal around? Let's say as we get through the typical cycle post meeting, folks are out in the field speaking to all kinds of different gatherings to make sure that there's like a very clear unanimity and support of the Fed cutting rates, because I don't know, if Jay Powell has really taught us anything, it's that he wants to make sure there is alignment, with his team before they do anything big, and certainly, to cut rates at this point in the cycle, is going to be seen as such.
Well, I'm not sure the voices that we hear between now and the September meeting will necessarily satisfy the market in terms of alignment. There could be quite a number of different views, but those views will be tactical. Strategically, this committee is aligned. There's no one on the committee who's saying the Fed is doing exactly the wrong thing. No one who's really suggesting a complete difference of priority between employment and inflation. Strategically or direction-wise, I think they all agree. What we may hear is different views as to the timing of the first cut.
I'm also curious about outside influences on the committee. And for once, I'm not necessarily talking about the election. I'm talking about everyday Americans. There was a new poll out from Morning Consult that said 68% of U.S. consumers said rates are too high right now. Of course, probably at least an equal number would still say inflation is too high. So make of that what you will. But I am curious what these guys are hearing in their districts and how they're taking that into account in terms of the decision making.
The district process over the years, and I'm told since I left, has continued to be refined in each of the 12 Fed districts, and they fairly systematically get views from corporate leaders and community leaders, and they do surveys. So I think the presidents are very definitely influenced by that. And in some respects, the information is more immediate than the data that they're looking at, which often mostly arrives with a lag. So the presidents are influenced, and the governors listen to what they're hearing. It does have some effect, but much of what is collected is not, strictly speaking, data, and therefore is viewed as sort of a second form of information.
And then I guess looking past that initial cut in September, I'm curious if you have any thoughts around, what the path over the next 18 months either could look like, should look like, what kind of destination we may be headed towards. And we've seen the last couple dot plots more discussion on where that terminal Fed funds rate is. I'm curious how you're thinking about, really, I guess, the location of our star at this point.
I don't think as they kind of nurture this soft landing that they're going to start from a first cut and then march to a neutral rate. I expect a more tactical approach where they make a cut and perhaps wait 2 meetings to consider the second cut. I think we're going to see more of a calibration approach than we're going to see a major shift in monetary policy to be accomplished in regular 25 basis point increments at each meeting. So I really would expect that they'll take their time often between cuts.
Dennis Lockhart, really appreciate your perspective this afternoon. Thank you.
Thank you.
Well, in just a few moments, Fed Chair Jay Powell will be taking to the podium at the press conference to explain the Fed's reasoning in a little more detail and to take questions from the press. But after we got that statement here, we are seeing stocks hold onto their gains pretty darn steady. We'll see if that changes during the presser. Miles, I think Dennis Lockhart made a really good point there, which is that sort of Jay Powell might be motivated at this presser to not say much because he does have the Jackson Hole conference at which he can further give precision on his view.
Yeah, I think, though, as Mr. Lockhart mentioned, that speech at Jackson Hole has been in progress, and the Jackson Hole speech typically is where the Fed chair can lay out their priorities, really for like the direction of policy theory, let's say, over the next several years. I mean, Powell's speech at Jackson Hole in 2018 is one I still reference all the time because it was his first one, and a lot of what he talked about there has played out in all kinds of various ways over the last 7 years. So we'll see how that plays out, and of course, this is the main event.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from a peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP growth moderated to 2.1% in the first half of the year, down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs to workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Gina. Gina Smilik from the New York Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be the inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market, too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about that we've said in our statement that we're going back to looking at both mandates, and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normalization of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have 2 mandates, as you know. The labor market, maximum employment is one, and stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more than that, and it wouldn't be any one statistic, although of course the unemployment rate is generally thought to be a good single statistic, but we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say, again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think core inflation was actually running below 2%. So I don't now think of the labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber at Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw risks of an unexpected cooling? Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of I don't think of it that way. I think of it as we're actually in a good place here. We're balancing these two risks of go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates, and I think this is how we balance them. It's a rough balance, but it does feel like again the labor market feels like it's in a place where it's just a process of ongoing normalization. 4.1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question. Talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now of thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So, we actually got to this. We raised rates a year ago at the July meeting, And if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market, as I think, unemployment was in the threes, mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is, how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most rate, you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be, because the pace at which it might happen, because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is, you got 1 quarter of that. We had 7 months of low inflation. You got 1 quarter of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're reporting too low inflation. If you smoothed it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably under 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices, or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year, and the time is coming, as other central banks around the world are facing the same question. The time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Certainty is not a word that we have in our business. So we get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence, Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, we had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got another quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have we had a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney.
Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation. Rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. I mean, just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment is still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say that the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So, again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So, again, I've been through some of the data already, but what we think we're seeing is a normalizing labor market. And we're watching carefully to see if it turns out to be more. If it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
Amir.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling us, such as the very recent downbeat beige book, and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of, there are spots of weakness, and there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%, and that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter. So it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary, but we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right, the economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically, we have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened yet. That would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine.
There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean. Hello, Jean Young with M&I Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examined the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see which way the economy heads, and I think if we are to respond to weakness, we're certainly well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we have to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks, but nobody has great vision deep into the future. In terms of a reaction function, that's a long time discussion that people have had forever. I think people have understood for a long time, actually, that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data, really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing, which could be very beneficial down the road. But we don't have, on a CBDC, we don't have any plan we would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That was Federal Reserve Chair Jay Powell speaking following the latest decision by the FOMC to hold interest rates steady. He was repeatedly pressed on whether the Fed would be cutting rates in September, and he repeatedly backed off from being more precise, but it does seem as though a lot of the economists who are watching this, got a note from Krishna Guha, for example, over at Evercore ISI, who does say that this prepares the groundwork for a rate cut in September.
Yeah, I think September is pretty much done at this point. I think the way that Chair Powell tried to talk around the issue of having necessarily locked in what the Fed is going to do in 6 weeks, they always want to retain the optionality. We heard much of the same language that we've heard from the Fed chair over the last year around needing to see data, greater confidence, et cetera, et cetera. But, and I know we'll talk to her just in a few minutes here, but Jennifer Schonberger, Yahoo Finance, asking, Chair Powell pretty much point blank, did your discussion today kind of set up, a cut next meeting? And he started his answer with yes, and then, added a bunch of qualifiers. But I think clearly there is a sense, and, he mentioned there was a strong discussion among the FOMC today about whether they should have cut today. And I think very obviously the Fed is moving towards a rate cut in September, and why wouldn't they be? That's what the market priced in, and the Fed got the market to where they were happy to have them sit. We can, go on vacation for the next 6 weeks.
That's a great idea.
Well, the NASDAQ goes up 3% every day, or now it's going up again. So
right.
Hey,
and then we should put the market board back up because
let's enjoy this.
We are seeing now the NASDAQ at one point was up a full 3%. Now it's only up 2.8%. Obviously,
a mere 2.8%.
Still seeing a strong rally here. There were some interesting details as well in the press conference. He was asked by someone if 50 basis points, a half-point cut was on the table. He says, we haven't been thinking about that at all. He also said the chances to him of a hard landing at this point look low. So I thought that was interesting, and talked a lot about normalization of the labor market, that he is not that concerned, doesn't seem that concerned about it falling off a cliff.
Yeah, the idea of this being a normalizing economy, there's plenty to parse out here over the next couple of days, but I think an illuminating press conference, let's say, from Fed Chair Jay Powell. Joining us more on the Fed and everything else happening in markets, Ann Berry joins us now, Threadneedle Ventures founder. Ann, what did you make of what we heard from Powell? What do you make of the market reaction today? Obviously, we've had a lot more in markets today outside of the Fed world, I think, is really driving the action. But as we sit here, pretty much now locked into waiting the next 6 weeks for the Fed to just get on with it. What were your thoughts on both what Powell said today and ahead of this? Did you feel like, July should have possibly been on the table for the Fed?
I don't think July should have been on the table. And what I heard was classic Jay Powell preserving optionality. We heard a lot of conversation, a lot of data, which basically points to this being a Goldilocks economy at this point. And they basically said it. It feels not too hot. It feels not too cold. We've got inflation coming down towards our target. At the same time, unemployment isn't, we're not heading cliff levels in the labor market. So I don't have the same conviction that the market has that there is going to be a rate cut in September. I did not hear that there was a catalyst that would make that a done deal. I think we're still in wait and see. I think there's still a chance that we're flat in September, just as we were today.
So, Ann, your business has touched a lot of different aspects of the economy. Do you agree with the assessment that a hard landing is not in the cards and that this is a Goldilocks situation?
I do think a hard landing's not in the cards. And I think the big thing, Julian, I remember you and I talked about it last time I was on your show. We talk a lot about the headline rate, as we've done today. There's a piece of this that we don't talk about, and I want to point to an op-ed that Kevin Walsh wrote in the Journal, which I thought was phenomenal reading yesterday. We don't talk about the size of the Fed balance sheet, which is now north of $7 trillion. And the reason it has become so big is because federal spending, fiscal profligacy has been so enormous that the Fed has accommodated by buying a bunch of long-dated government bonds. So we haven't seen rates really come down as much as you might expect when it comes to long-dated treasuries. And I think as we go headlong into seeing what fiscal policy is going to look like for the next 4 years, Julie, I think that's the bigger concern right now. I think that remains, frankly, an inflationary pressure, and I don't see rates coming down yet as a result.
So in other words, you think even when the Fed does begin cutting, that, long and variable lags that we've been talking about on the upside for rates, forget about that. I mean, it'll be really long and variable lags because of that cushioning effect you're talking about?
Well, I think there's a couple of things, right? We're going to see continued inflationary pressure if we don't see fiscal policy get reined in. Over the longer term, we've seen this decline towards 2% now, but if we see federal spending bump back up again, or at least not come under control, if the deficit continues to expand the way it does, we're going to see upward pressure on inflation again, and as a result, we probably want to see that filter through into Fed policy again. So, I think the Fed's going to tread very cautiously at this point, Julie. If there are cuts in September, again, I'm not convinced there are going to be. I think they're going to be small, incremental 25 basis point changes as Fed Chair Jay Powell treads extremely carefully going into a new administration.
So, and I guess if you take all this together, it really seems like, in your view, the Fed has a much more challenging task ahead of it rather than just figuring out what the target range for the Fed funds rate should be. And I guess it would track then that, you go from, rates at zero, you raise rates most aggressively we've seen in 40 years. You're not just going to get out of it in, 12 clean months. And it feels like when you take a step back, the Fed is in a much more precarious position over the next several years than maybe the market's focus on, mid-September this year might otherwise suggest.
I think we've got to sort of ask ourselves, what are the cards that the Fed has got to play at any point in time? Right, it's got the headline rate, and it's also got the size of its balance sheet and whether it's shrinking or expanding its balance sheet, putting liquidity into the economy. If the Fed starts cutting now and we have another shock to the system, and we've had a couple, right? We've had the pandemic, we've had political instability. Who knows what we're going to have next? You kind of ask yourself, what levers has the Fed got left to pull? It does need to have some tools at its disposal to have some buffer in the case of exogenous shocks. Now, if right now we have this Goldilocks-ish economy, which they basically said in so many words in the presser today, it does beg the question, why rock the boat right now? Just because the market's expecting a cut doesn't mean that they have to deliver one. They have to keep looking at the data. And I think this is where, at least despite the criticism, Jay Powell's been extremely consistent. When and only when they see that 2% target right there on the immediate horizon, are rates going to start to move?
And I want to get into the market reaction that we're seeing today, which is very positive, especially among tech stocks. Now, they were rallying before, but we saw them build on those gains after the statement and the press conference. What do you make of that reaction?
I think, Julie, when you look at how the market's tended to respond to the Fed comments in the past, it's always tended to hear what it wants to hear. Again, I remember you and I having these conversations where I'd say I'd find the market reaction to some of the comments by the Fed completely perplexing. Even when the Fed has consistently said we're going to be data-driven, we are probably not going to move rates yet, we've still seen the market have these little bursts of euphoric activity right afterwards. I think we're seeing that today. Right, the market is choosing to interpret the comments of the Fed as it being extremely likely, close to 100% by some predictive metrics, that there'll be a cut in September. And as a result, tech in particular, which is highly rate sensitive, is seeing a pop in prices today. Again, I'm not there yet. I wouldn't be surprised if the Fed doesn't move in September, and I think we get a negative reaction from the market then.
So then, Ann, maybe taking a step back from just what we heard in the last hour or so and looking at the market behavior really over the last couple of months in this rotation we saw in July. I think investors trying to figure out what the next leg of this trade is, whether it's an AI trade, whether it's a Fed-related trade. How are you seeing the landscape? And I think, of course, what was mentioned in the Fed meeting we haven't mentioned so far is this looming election risk, only a few months away here in the U.S., and how you've seen the market action, which, while to the upside, has been quite volatile over the last handful of weeks.
Well, I think the market volatility, Miles, that we've seen over recent weeks has reflected the volatility that we've seen in the political landscape, right? The slate of candidates that the United States thought might be up for the vote has changed. And as a result, you have seen the market perspective change. What does it mean if one ticket ends up in the White House? What does that mean for defense stocks, energy stocks, banking stocks versus another one which feels, perhaps more business as usual? I think one thing that is looming, Miles, and we started to see that change a little bit at the end of last week, and we're seeing it in both public markets and in private markets, is something you just touched on, which is the AI trade. I think we've seen huge AI euphoria over the last 18 months. And what we're now seeing, both in the venture capital world, where we're seeing a little bit of agita around whether there has been an AI bubble and people really beginning to hold their breath at valuations that have been coming out. I think we've been seeing it in the public markets as well. We saw it in the reaction to Microsoft. We're seeing it in the reaction to names like Meta and the anticipation around future earnings for some of these companies that have leaned really hard into what their AI story is supposed to be. The street's starting to say, show me the money. And if some of these tech names don't start showing the money, showing the profit coming from AI, I think we're going to be in for a bit of a rocky fall.
And do you think that those questions are justified? And are those conversations also happening in the private market between funders and founders, for example?
They're absolutely happening in the private market, Julie. There's no doubt about it. We saw really at the beginning of last year, end of last year, these young businesses which had AI articulated in some fashion, whether fleshed out with real specificity or whether just high-level buzzword hijacking, bringing AI into their stories, able to raise large amounts of money extremely quickly at very big valuations. And I think the private market has stepped back a bit and said, hang on a second, we're having slight 2021, early 2022 deja vu. We better really make sure that we're underwriting with the discipline that we should have been underwriting with coming out of a tough post-COVID capital deployment period. We're seeing the same in the public markets, Julie. Again, when you look at Microsoft, look at the questions that are being raised around data center investment and whether that's going to pay off in the long term. So I think we are going to see a bit more rigor kick in. We're seeing it again in the private markets. I think the public market is a little bit overdue, but I think it's coming.
We'll wait for it. And good to talk to you as always. Thanks a lot.
Guys.
The Federal Reserve holding rates steady while Fed Chair Jerome Powell points to the possibility of a rate cut in September. Let's get to Yahoo Finance's Jennifer Schonberger with the details. Of course, you and your peers there in the press room pressing him on when that rate cut was going to happen, if it would be in September. What was your takeaway from being in the room?
Hey, Julia, he was pretty forthcoming considering the statement. He, of course, didn't say that the Fed has made any decisions about future meetings at this juncture, but that the time is growing closer for the Fed to begin cutting rates, and that September is a point of more confidence for the Fed. Take a listen.
The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
When I asked Chair Powell whether there's a growing sense of confidence among committee members that the Fed could go in September, he told me yes. Now, Powell says if they see inflation continuing to move down in the manner that we've seen over the second quarter, if the job market remains kind of where it is currently and the economy remains relatively strong, as we've seen here in the second quarter, then that would be a recipe for the Fed to likely cut in September. However, if we were to see more volatility, more stalling in the inflation data, then they would need to rethink that. However, he says it's very much about the balance of risks here. So they're very much weighing the employment side of their mandate again, not just inflation, as we saw in that statement. Chair Powell said there was also a real discussion within the committee about pulling the trigger, cutting rates at this meeting, but the majority of officials decided against that. While they are encouraged with the inflation data they've received in the second quarter, they still need to see more good data before cutting rates. He says we're in a different economy now with the labor market cooling and inflation coming down. The time is, quote, coming to adjust. And lastly, I just want to note that Chair Powell was asked about President Trump's comments that the Fed should not lower rates in September, and he thinks that the Fed can make decisions in an apolitical manner. He says we never use our tools to support a political party or a particular political outcome. Bottom line here, guys, the Fed seriously eyeing September. Back to you.
Jen, thank you so much. Our own Jennifer Schonberger there in D.C. And Miles, thanks so much for being here
thanks
to
for having me, Julie.
surf through
What a treat.
the Fed.
I just kept the seat nice and warm for Jared.
You did a
Who
great
now has to
job,
come deal
and
with it.
Jared is now going to come and talk
looming.
about what's going on
He's
in the
looming.
market. That concludes our Fed Day coverage. Market domination begins on the other side. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern. Welcome back. It is time for Market Domination. I'm Julie Hyman alongside Jared Blickery, and we want to start with the market action here today, Jared, following, of course, the Fed not changing rates, but a press conference that seemed to, at the very least, leave open the door for a rate cut in September. And stocks coming down off their highs of the session here pretty much across the board, but the Dow is performing the least well of the major averages.
That right there is nothing. That is a very small move for an FOMC day and a presser. If you dial up the the NASDAQ, that was up more. So let's see.
Yes.
It's still holding on to gain of 2.6%. That is barely a blip.
It is barely a blip, and it's pretty much back to where it was.
Yeah.
I mean, we had the movement, and it's back to where it was. The S&P 500 also similar here. So it's really the Dow moving the most post-meeting versus the other major averages.
And then sometimes you see more action in the bond market, and if you go to the 10-year, we'll take a look at that as well. That's the T-note futures, and we have the yield right there. But that actually ticked down just a tiny little bit, 3 basis points. So for a meeting, 10 basis points we've seen in previous ones in prior years, 15, 20 basis points. You see the stock market up 2%, down 2%. This is really just, I think it did not only open the door, it is just wide open for September. Powell had every opportunity to pull cold water on the possibility. We do have an election after that. That is not the case. The market is now prepared for and is expecting, and the Fed is prepared for a rate cut in September.
Oh, so let's dig into the sectors here and what we're seeing. And it's really the strength in tech, consumer discretionary, just flying here today. You can see that, of course, in the outperformance of the NASDAQ, too. You've got healthcare that's weak, financials, although banks earlier touched a 2-year high.
Interesting. And regionals were actually flying more than the big banks. But
right. So this group in particular, you've seen it now go negative.
Yeah, but 14 basis points. Again, these moves are just really, really small, especially in some of the cyclical ones. Let's take a quick peek at the NASDAQ 100, where we see some, look at that action. Nvidia up 12.5%. I think in a few days, you might be talking about record highs, but it's been in a massive range. Let's just take a quick look at Nvidia here year to date. This is a stock that tends to consolidate more than it trends, but this was getting people a lot of nervousness only yesterday. It's just a remarkable turnaround. I was looking at the turnaround days from before and after when chip stocks do this. It's not that frequent.
2 more things I just want to quickly mention here. The 2 big reports after the bell that we are awaiting. Meta, which is rising into that report by 2%. And then Qualcomm, which is up nearly 7%, up 20% year to date, but up 7% ahead of reporting its numbers after the bell. We'll be covering that. In the meantime, let's turn to Boeing. Those shares are soaring after the jet maker named a new CEO and reported earnings this morning ahead of the open. Joining us now is Ron Epstein, BofA Securities Senior Aerospace and Defense Analyst. And Ron, obviously the news of the quarter overshadowed by the announcement of the new CEO. Tell us about how this sort of positions Boeing going forward.
Yeah, I mean, one of the big uncertainties with Boeing was who's going to be the next CEO, right? And it was sort of like this game of, guess who it's going to be. And it leaked out maybe a couple days ago that Kelly Ortberg was kind of high on the list, and then we just found that out today. So, the choice of Kelly, I think, is actually a very good choice. He was the CEO of Rockwell Collins. He was there for his entire career. Grew up in both sides of the business, knows the defense business quite well, knows the commercial aerospace business quite well, and then ultimately sold the company to United Technologies. And then after United Technologies merged with Raytheon, he was a special advisor to Greg Hayes, who was the CEO of Raytheon, or RTX today. So he's a very capable person. He's an outsider from Boeing. A couple points I would note. Rockwell Collins had a fantastic culture. And one of the things we've been talking about, and I think others have been talking about, that Boeing needs sort of a culture change. He could be a real catalyst for it, given his kind of formative years as an executive in his career at Rockwell Collins. Rockwell Collins invested in new products, and for the long term. They also had good focus on financials. They had very happy customers, very happy employees, happy shareholders. So it was kind of a nice balanced capitalism approach that Rockwell Collins had. So I think Kelly is a seed that could be planted and really kind of start to germinate a new culture at Boeing. Being a Boeing outsider, he also has a lot of contacts in the industry that he can bring in that are kind of outside of just sort of the Boeing envelope.
Well, let's talk about the path he has in front of him. A very big turnaround effort. What do these latest results tell you about what's needed in the path ahead?
Yeah, so we've said a number of times in the past that this is a really heavy lift, right? So pretty much, if you look at the defense business this quarter, they had lousy numbers. You look at the commercial business, they had lousy numbers. So far this year, in the first 2 quarters of the year, Boeing's burned through about $8 billion of cash. They've also said in the third quarter they'll burn through cash. So there's a good chance by the end of the year, Boeing could burn through maybe $8 to $10 billion of cash this year. So you have a balance sheet that's been weakened. You have customers that aren't happy. They're being investigated by multiple government entities, NTSB, FAA. So you have a relationship that you have to fix with the U.S. government. And you have a labor negotiation that's going to come up on September 12th. So you have everything between working with your employees, working with your customers, working with the government. So it's a heavy lift. It's something that one person can't do. Kind of back to my point, Kelly's got a big net that he can throw out there and hopefully recruit people to help him do it.
What is the most important? I mean, as you say, that's a lot. What's the most important and urgent thing he needs to address day one?
Yeah, I think day one is the culture and the people of the company. I wouldn't be surprised if on day one he moves out to Seattle. One of the things we've been calling for is you have to have management where the critical mass of your manufacturing is. Their biggest manufacturing base is in the Puget Sound. So I wouldn't be surprised on day one if he just starts out in the Puget Sound. That sends a really strong signal that he's committed to the Puget Sound, committed to manufacturing, committed to the business. So I think the most important thing that he can start addressing on day one is the culture of the company. And then that will work its way through everything between manufacturing, on the financial side, the customers, and the whole thing. But culture is really the glue that's going to hold it all together.
Boeing was once known as the engineers company, by and for engineers. Really appreciate your insights here. Thank you, Ron.
Yeah, my pleasure.
And coming up, we are counting down to the closing bell and getting you set for another afternoon of earnings. Stay tuned. More on market domination on the other side.
Bill Ackman's Pershing Square USA is withdrawing its previously announced initial public offering. And this coming after demand appeared to wane for that offering. He's saying in a statement today, over the last 7 weeks, we've met with many institutions and family offices. We've held numerous town halls, and they've had a lot of investor interest, they said, but they kept getting the same question. Would investors be better served waiting to invest in the aftermarket than the IPO? That's not really something you want to hear when you're raising money for an IPO.
No, and I think it might have a little bit of something to do with the peculiarity of this is a closed fund offering. This is not the corporate structure you see IPO every day. But I think the end result that there was this discussion about $25 billion, then the range was lowered to $2.5 to $4 billion, and then it was $2 billion, and now it's nothing. I think that says something about the demand for this particular offering. More concerning, I think the question is it representative demand overall for IPOs? You just forwarded me an article earlier today saying the window is open.
Right, that was from the Jefferies CEO, Richard Handler, who's saying the window is open.
And maybe he's talking his own book, but I do see a lot more risk taking this year, especially as opposed to the 22 bear market. Things open up a little bit. They thawed a bit at a time, but there has been no deluge. So I'll be interested to see if what happens with the next one.
This does seem to be a bit idiosyncratic, this situation, because of the reports initially, as you say, that it was a $25 billion, that was going to be the size of the offering. Then Ackman sent an email to potential investors where he gave a little more color. After the fact, decided that had to be disclosed to the SEC. Once that was disclosed, then it was postponed, and now you get a cancellation, although he is holding out the possibility that this will be restructured and brought to market once again. So canceled or at least postponed for the foreseeable future. So we'll see what happens.
Yes, we will. All right, let's check in on some of today's top trending tickers. First up, Marriott shares sliding despite a beat on earnings. The company lowering its 2024 revenue per available room growth outlook, in part due to a weaker operating environment in China. And I did have a couple notes here. One is from Citi. They write the stock in neutral, price target 250. The analyst saying that he expects near-term weakness in the stock given the relatively high valuation metrics and also because forecasts have been trending lower. Quote, on a positive note, net rooms growth unchanged at 5.5% to 6%, and capital return remains robust. So the cash position, always an important metric there. Bernstein saying the second quarter results were in line. Full year downgrades, so the outlook speaking here, show that Marriott is not immune from all the effects of a consumer slowdown. So then touching on the state of the consumer as well.
Yeah, and China really does seem to be a big part of the issue here, although the company does get 3/4 of its revenue, give or take, from the United States alone. But China is presenting a challenge here. The company talked about that, the weaker operating environment and marginally softer expectations in the U.S. and Canada. One analyst, Patrick Scholes over at Truist, saying that revenge travel fatigue is happening in China specifically, although I imagine in the U.S. there's something of that effect as well.
I might have that.
Yeah, let's also talk about Vistra shares surging after a positive capacity auction by the largest grid operator, which is PJM Interconnection. It's not just Vistra, by the way.
I had to look a bunch of this stuff up.
It's Talon, Constellation Energy, NRG Energy, Public Service Enterprise Group. So really the whole spectrum of these companies that got this. Why? What does all this mean? It means power prices are going up.
Oh, big time.
That's what it means. So basically, you've got a potential record high as you've got plant retirements, as you've got surging demand, and then this auction sort of an indicator that is the direction that things are going here.
I got the prices real quick. Scott, the prices at the last auction that we're talking about, $269.92 per megawatt day. That's just, forget about the units, $269 versus $28.92 at the last auction. I believe that was a year ago, but so that's a tenfold increase, and that kind of tells you where the state of the market is.
It does, and tells you why these stocks are higher today.
Yes.
All right, let's also check in on the commodity market. Crude oil prices are jumping as we've got Middle East conflicts escalating. Traders eyeing the threat to global oil supplies amid rising tensions between Israel and Iran. For more on oil market jitters, we want to bring in Vikas Diavetti, Macquarie Global Energy Strategist. Vikas, thank you so much for being here. It's so interesting to see this reaction today. And I want to leave aside the Fed meeting for a moment because I know there's something of that playing in here as well. But, there have been a number of different events that could be viewed as escalations, not least of which was Israel striking in Beirut to target a Hezbollah commander. But now this strike within Iran does seem to, the other things didn't affect the market. This strike in Iran did seem to affect the market. Why is that? Vikas, I think we're not hearing you right now.
There we go. Hey, sorry about that.
That's okay.
Yeah, it's the accumulation of what the market views as escalatory moves. One incident, you can sort of move past it, but two or three bunched together quickly. And I think the mode of the way those operations, the type of operation it was, will also matter once that's all known. But the market isn't waiting on some of those details because I think the big picture idea is that this has been a controlled set of skirmishes and back and forth. And all sides have been measured and saying, like, look, I have to respond, but in a measured way. I don't want this to overflow into an all-out regional war. But at some point, if there's enough of this going back and forth and the shoving is getting tougher and rougher, then you start reaching these levels where it's like tougher to go back, right? And we don't think we're there yet, but the market certainly is viewing, the last couple of days events as getting closer to the point where it's difficult then to find an off ramp, and then then the odds start to change, right? Instead of de-escalation being the primary MO of all the players, we starting to think that escalation is going to be the bigger factor now, and de-escalation has got a kind of a lower odds of happening, at least in the near term.
So I want to get to the news of the day. Federal Reserve standing pat on interest rates, opening the door for September. Any play on that within the energy sphere or just in terms of markets in general that you'd like to comment on?
Yeah, I think the market is viewing today's FOMC as constructive, but I think it's been lost in the mix because of the Middle East. So it's hard to parse out how much of today's move is related to the Fed and how much is related to the Middle East. But our view is based on conversations we've had today and the nature of the price action. Let's say none of this had happened, right, in the Middle East. You would still get a little response, but not that big, because I think the micro factors in oil are worrisome. Demand growth is struggling, and the market is viewing 2025 supply-demand balances in surplus. That may not be fully consensus yet, but it's trending that way, right? So some of the micro items, not constructive, could kind of the Fed results have dragged oil higher, probably, but not anywhere in this magnitude.
Vikas, also, what should we make of the fact that inventories in the United States, specifically crude oil inventories, are at their lowest since February? They've been falling for 5 straight weeks. Is that something that is just sort of a characteristic of summer driving season, or is there something more going on?
It's a seasonal item. And actually, it's a good point. The U.S. has been drawing, but globally, the draws, which were also supposed to be noticeable and sort of fairly clear and large, have not actually happened. We have been drawing, but very marginally at the global level, according to a lot of the satellite data that we track. And there's been a little bit of a disappointment in the market because, we should have been drawing at bigger levels. Now, that's not to say it's over. Last year, we didn't get the really big tightness in the draws until the end of the third quarter. And it finished really strong at the end of the third quarter, and then it gave it all back in the fourth. So I think the market is, ex the Middle East events that just happened, the market is trying to figure out, can I get long and then get off this trade in time for what could be a surplus and a much softer fourth quarter oil market. we introduced this Middle East factor now, and I think this is going to have its own life until there are de-escalatory news items coming out, which we're not expecting right away, by the way. I think it's still in ramp-up mode.
It feels that way. Vikas, thank you very much for your perspective. Appreciate it.
Thank you.
Well, we're wrapping up today's Market Domination. Don't go anywhere. After the bell, the earnings fun begins. We've got you covered with all the latest numbers from Meta, Qualcomm, ARM, and more. Stay tuned for Market Domination Overtime. There's the closing bell on Wall Street, and now it is Market Domination Overtime. So let's start with where the major averages ended this session following the Fed meeting, following the presser in which it seemed as though Jay Powell, the Federal Reserve Chair, was saying, yeah, September's a possibility. The Dow coming down off its highs of the session, but still finishing up by 100 points, up about 1/4%. The S&P and the Nasdaq largely hanging on to their gains with a 1.5% and more than 2.5% gain, respectively here. Seeing really a rebound in technology to characterize the session, led by Nvidia after some positive commentary out of Morgan Stanley on that stock. We really saw some strength there, leading to really the gains that we saw broad-based within the NASDAQ 100. So interesting there. Nvidia, Jared, finishing the day up almost 13%.
Yeah, I'm looking at that on the Wi-Fi Interactive. As you said, 12.81%. It's up another 0.2% in after hours. And if we haven't already, we're about to get Qualcomm earnings as well. And it looks like Qualcomm, I see that stock is up 5%. So interesting to see what those results will be. I could break those right now. I have them right in front of me. We do see that their fourth quarter revenue estimated to be $9.5 to $10.3 billion. That is, it looks like the estimate was $9.7 billion, so that is a big range there. It looks like they exceeded that range. Also seeing fourth quarter EPS, $2.45 to $2.65. That is higher than the $2.45 that was expected. And then third quarter adjusted revenue, that's the one from the current quarter, the reporting quarter, $9.39 billion, slightly beating the estimate of $9.21 billion. And then adjusted EPS coming in at $2.33. The estimate was for $2.24. So.
Yeah. And Kinla, I just want to run through the different units of business here for Qualcomm here. QCT, that's their licensing revenue, rose by 12%. Their Internet of Things business fell by 8.5% by revenue. Handset revenue up 12%. Automotive revenue, the real standout here, up 87%. And that is something that the company has really been leaning into, chips that power smart vehicles, essentially.
All those robotaxis.
Yeah, all those robotaxis, but just other, other stuff, sensors, other things that go into vehicles here. And Qualcomm's really been trying to diversify in these various areas. Automotive still the smallest part of the business, but it's one of the ones that's been the most rapidly growing. Handsets is really the company's bread and butter. And so seeing a beat there. I'm just looking at the statement here, Cristiano Amon, who is president and CEO of the company, talking about the growth and diversification strategy, what I was just talking about there. And he also said, we're excited about the launch of our Snapdragon X series solutions for PCs. So this is going to be the next question for not just Qualcomm, but also ARM that we're about to get in a little bit. So just going to go through those numbers. But the whole question of AI PCs, right? What is the demand going to be from that? How much are we going to see not just uptake from the PC companies, but also uptake for consumers? Is that a product that they're going to want?
Yeah, if we can go back to the Wi-Fi Interactive just for one more second, want to show the current quote and just remind people, yesterday was a nasty day in semiconductors. I'm going to put a 2-day total on here and you can see, well, it's still dark green. We actually saw quite a bit of selling yesterday, but it wasn't as much as the bullishness that we're seeing today. But Qualcomm specifically, this is a stock that is down considerably off of its high, and we've just seen incredible volatility in the AI trade, in the chip space overall. It's a very secular industry.
Let's talk about ARM, shall we? Because I just mentioned that's another company that's sort of betting on this PC AI situation, and they're just out with their numbers as well. They're giving a forecast, so I'm going to go to that first because the company says second quarter revenue will be $780 million to $830 million. The estimate there, $806 million. So pretty much at the midpoint there, it looks like. First quarter revenue at $939 million, beating estimates, and adjusted earnings per share beating estimates by 6 cents a piece here. I'm just looking through the various other lines of business. The royalty revenue, a little bit light of estimates. Licensing and other revenue, though, ahead of estimates.
Yeah, I do see 100 billion AI-ready ARM-based devices deployed by the end of next year. That's 100 billion little devices out there, quite a bit. And here's another quote. As the energy needs of AI continue to escalate, so does the demand for the high-performance, power-efficient ARM compute platform. So just kind of speaking as to the broad demand for these chips overall. Also, here's another quote. AI demand and rising CSS adoption across major market segments drove this record revenue, and that comes from the CEO.
And I think one of the reasons that you're seeing the stock under pressure here is this second quarter earnings per share forecast of 23 to 27 cents. Analysts have been predicting the upper end of that, 27 cents. So that is perhaps why we are seeing the stock fall here. You know, it's interesting. We were earlier talking about the IPO market. And ARM was supposed to crack it open. Remember that when the company came public last year? That was sort of the narrative around it here. It came public last September at $51 a share. Now, the stock has done very well, but it took a little while to gain some traction and get going because the company was trying to sell itself as an AI play. Analysts were saying it's not quite there yet. Maybe in the future there's some promise, but it's not there. But it looks like investors have bought into that future promise with the amazing gain that we've seen in the shares.
Yeah, just real quick, Wi-Fi Interactive one more time. I'll chart ARM from inception here last year, and it's easy to forget that IPO'd only last year, but you can see it's up a net 126%, although 5% loss is what we're seeing in the after hours right now. It's been an interesting. It was an interesting IPO for a number of reasons, just because the company was so large by the time it finally came to market. And remember, they had tried to merge with Nvidia at one point. That was knocked down by competition authorities in the U.S. and the U.K. So there was quite the story there.
Yeah.
Do we have anything else on ARM?
We don't. We will.
Yes.
But right now we're going to talk about Meta. Meta earnings are out right now. And that company's second quarter revenue coming in at $39.07 billion, 38.34 is what analysts have been predicting. Earnings per share beating estimates by a pretty wide margin here, $5.16. 472 is what analysts had been anticipating. And the company for the third quarter says revenue will be $38.5 billion to $41 billion. Analysts have been looking for $39.2 billion, give or take. Here's an important part of what I'm seeing here. The company says it expects significant capital expenditures growth in 2025. So that's something that the street had been waiting for. Were they going to keep spending on AI, spending on Reality Labs, that unit? And it looks like the answer is yes.
And it looks like investors have taken that in stride, not weighing this on the stock price at all. Here's another one. Here's a quote: "Absent any changes to our tax landscape, we expect full year 2024 tax rate to be in the mid-teens. We anticipate our full year 2024 capital expenditures in the range of 37 to 40 billion, and that is up from their prior range." And that's what you were just talking about, basically. The money they're going to shell out for the next year, those spends on AI. You know, I've seen estimates for Nvidia. I'm going to switch gears just a little bit. It is related. I've seen estimates for Nvidia sales next year topping $200 billion. Yes. And that's just mind-blowing to think that they come from barely low double digits only a year or two ago.
Well, and to your point, Meta says that infrastructure costs will be the driver of expense growth in 2025. In other words, building out data center capabilities to handle the AI training and then inference. And that means something like Nvidia is a direct beneficiary of that. But it's interesting to see them talk about that. So seeing the shares go higher here, although giving up some of the height of the early gains that we were seeing, and certainly we'll see them move on the call as well as analysts press Mark Zuckerberg on what's going on with the spend, where is the spend going here. Also looking at ads revenue for the company, that has been beneficial to it. So that's something to keep an eye on as well, because that's a big part of the business. And as we look at these Meta shares jumping on second quarter results, let's get some more perspective here. Rohit Kulkarni is joining us now, Roth MKM Managing Director. Rohit, let's just start first blush reaction to the numbers that you're seeing.
Hey, thanks for having me. I think Meta was pretty controversial heading into print today, given what we heard from a couple other companies like Google as well as Pinterest yesterday. I think Meta was increasingly controversial. I think 2Q is less of a surprise based on what the expectations were. But the big surprise here is twofold. One is 3Q guide. Year-on-year comps are pretty tough for Meta for 3Q, and the guide that they have implies 20% growth on top of a very tough comp. That is one of the most bullish signals that the company is sending as far as all the things they are doing about AI and various different things. CapEx and operating expenses, we shall see. I think that weighs down on the stock. But overall, I think 3.5 out of 5 stars for Meta, particularly given what we were hoping or fearing coming into the print.
Do you think they could have gotten away with more CapEx? I mean, where do you think they lie within the realm of possibilities here?
Again, significant growth in CapEx, it remains to be seen. Again, Meta is probably on a run rate basis on like $45 billion CapEx by end of this year. So that's a very big honking number for this company. And that, what happens to the return on that CapEx and over what period, that is the biggest question mark, and that probably weighs on the stock over the near term. So we are, from here into the year end, probably we are in this kind of up 10, down 5, up 10, down 5 zone for Meta, because the velocity with which they are spending continues to go up.
You know, and I want to, you know, there's the future, the spending that they're doing for the future business, right? To really focus on AI. But in the meantime, they have an ad business, right? So let's talk about that for a second here, because they said ad impressions across their family of apps were up 10%, average price per ad up 10%. How does that comport with what you expected from the company and what we should expect from them going forward, given their size?
Yeah, I think the moment a company like Meta, which has essentially an auction-based model for pricing their ads, the moment they start to see pricing go up, that essentially is a way for us to read that this company is putting the right ad in the front of the right person at the right time. And they're improving that with AI. And over the last couple of quarters, for the first time in 2 consecutive quarters, in the last probably 2.5 years, Meta has shown growth in pricing. I think that's a very, very solid bullish indicator that now they can kind of pull down on the ad load and push on the pricing lever and essentially make a very, very profitable business, because AI is doing the magic that people wanted AI to do, and I think Meta is already there.
Where do you think, I guess this is a broader question, does it necessarily make a difference if one is a first mover in AI? Apple seems to be somewhat successful. It's adopted this strategy where we're going to be a little bit late to the game, but we're going to rename it in our favor. So Meta just launched Llama 3.1, and it competes with ChatGPT 4, 3.5, depends on how you slice and dice it. How does it stack up to the competition? And then again, does it really matter what's happening right now versus the end stage in a few years when things get really interesting?
I think these large mega companies like Apple, like Amazon, like Facebook and Google, they are just investing in AI because they will become table stakes maybe 12 or 24 months from now. So any company that's not investing in AI is probably going to be left behind significantly in the next 24 months or even sooner, probably. So while today's returns are uncertain, but 12 months from now, the value destruction would be certain, in my opinion, if they are, even if they don't have the first mover advantage. For a company like Facebook, that's essentially a single business model. They have a very, very focused approach on AI. All they want to do is improve their ad business, and all they want to do is improve their consumer behavior on their ad platforms. So it's a very focused effort on AI, and I think that is what is delivering returns already, given the company has reported 4 quarters in a row of 20% revenue growth while outperforming absolutely any ad player out there. So they're gaining share, and part of the reason is of their AI investments.
So maybe you can help me understand something here, Rohit. Mark Zuckerberg in the statement says, Meta AI is on track to be the most used AI assistant in the world by the end of the year. Now, I, like many people, have a Facebook account, I have an Instagram, I have a WhatsApp. When I type into the search bar on Instagram, it says it's their AI. But I'm just searching. Is he counting that? Like, does it count when I go into Google and I type in a search and it gives me an AI answer? Like, I would think that would still be more than just searching on, I don't know. I'm just a little confused about how we're measuring all this, I guess is what I'm saying.
I hope they're not counting that, Julie. I think, I hope the way they're counting is users actually chatting with Meta AI, as in going to ai.meta.com and actually creating an assistant like look and feel, like how you do with ChatGPT. His most direct kind of competitor is ChatGPT, and that's where they hope that Llama 3.1, GPT-4o are comparable, and hence probably Meta, with their in-house data that they have, has a better performance and a better adoption curve. So I hope it's not the simple search bar. I think it is actually people engaging with AI through the chatbot.
Great insights, and thank you for joining us here, Rohit.
Thank you. Thank you for having me.
Coming up, more on Qualcomm following the company's latest earnings report.
Ever wonder why a stock suddenly drops double digits?
Or Bitcoin unexpectedly hits record highs.
We're unpacking the catalysts driving daily market action
and explaining the chain reaction.
Why are oil prices trending lower despite ongoing geopolitical tensions?
Or why a company's stock is up even though it missed on earnings. Insight from top strategists, economists, and business leaders will help you make the smartest choices for your portfolio.
This is Catalysts.
Tune in daily, 10 a.m. Eastern on Yahoo Finance.
Qualcomm third quarter results topping Wall Street expectations as the company reports a beat on the top and bottom line and also delivered an upbeat forecast for the fourth quarter. Shares are rising after those results, and Morningstar equity strategist Brian Colello is joining us now to discuss. Brian, so as you look at these numbers, does it signal to you that the company's smartphone business is really showing a good recovery here?
It does, and we've been looking for this for some time. I mean, it really couldn't get much worse than what we saw at the end of 2022, start of 2023. So this is a natural recovery for Qualcomm to be bouncing back. We see good things across the board, revenue and EPS. The guidance was good, and even the auto side, which is a smaller piece of the business, that was a bit higher than what we were expecting as well. So some really good things out of this print for Qualcomm.
And what about the forecast looking for adjusted EPS of $1.45 to $1.65? The estimate was kind of the midpoint between that. What do you see there?
Yeah, I think the EPS was good, and I'm looking at sort of on the non-GAAP basis, I guess $2.55 for the September quarter. So overall, I think I think the company's bouncing back nicely. This is still, the PC story is very much a multi-year story. So I don't think we're going to see too much upside from it in the September quarter. So that's not too much of a surprise. But the smartphone is steadily recovering. So I think we're in good shape there.
Talk to us about the concept of edge AI, right? These AI chips on the devices themselves, not just PCs, but also the phones, and kind of where Qualcomm plays in that. And do we learn anything new this quarter as a result of that business?
Yeah, we'll be listening for more of that on the call. Certainly the chip makers have to be ready for when these new technologies emerge, and Qualcomm is adding the capabilities to do that. So we still see the AI development being focused in the cloud, for larger workloads, but we're going to see smaller models over time. And Apple's a great example of this, bringing a smaller model to its device to run locally. Qualcomm's going to have the same thing. There are going to be a lot of smaller models being run on devices, PCs and smartphones, and Qualcomm is rightly getting ready for it.
And how does that fit in with their partnership and licensing deals?
Well, the licensing is a bit different in our view. So that's just, collecting a royalty on every 4G and 5G phone out there, and that business is as steady as she goes. They certainly have the technology to expand in 4G, 5G, probably 6G as well. But that's a royalty stream that they can use to put into R&D to really push the needle on the chip business. And that's what they've been doing for, the past few years, and they'll be doing it for several more on the AI side.
Brian, the automotive business is still pretty small as a percentage of the whole, but growing quite quickly, more rapidly than any other part. What do you think is the potential of that business?
Well, I think there's good potential there, and I think it makes sense for Qualcomm to be taking its smartphone processor expertise and moving into new markets. So PC is one, automotive is another. We're seeing electrification of the car, more and more processing power in the car, and that is going to be a multi-year, multi-decade trend. So Qualcomm's going to be in that mix, Nvidia as well, NXP, Texas Instruments, and some others. So Qualcomm won't be alone, but they're certainly going to have some great opportunities to have more processors and more connectivity in the car. So that's something we're optimistic about long term.
So forget the base case for a second. What's your most optimistic case on auto adoption and these technologies as they're dispersed and enter the auto industries here? How bullish could you get?
Oh, that's a good question. I mean, they talk about a $4 billion sort of revenue business a couple years ago, and I think last we heard was a $45 billion pipeline. So that pipeline can just keep growing and growing and growing. I mean, there's so many places in the car where processors could be needed, from the infotainment system to all of the safety systems. And that doesn't even sort of count like when you get into an autonomous driving world and you need much more processing power there. So there's really a lot of places for digital processors. So I think Qualcomm can do quite well in this business. And I mean, if they were to have some sort of clean sweep, I mean, we doubt it, but if they were able to take like the vast majority of this market, I mean, it'd be tremendous upside for the next couple decades.
Well, right now we're seeing upside in the shares following this report. The shares up about 6%. Brian, thanks for your perspective. Appreciate it.
Thank you.
And that'll do it for today's Market Domination Overtime. Thanks so much, Jared, for hanging out here.
Stop by on Fed Day.
Helping us. Fed Day, earnings. We got a few things going on. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay with us. It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is Market Domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers,
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern. Hello and welcome to Asking for a Trend. I'm Julie Hyman in for Josh Lipton. And for the next half hour, we'll be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here are some of the trends we'll be diving into. The malaise for the Magnificent Seven taking a break today. Meta shares jumping after the company reported better than expected second quarter results, and third quarter revenue guidance came in above estimates. The social media giant also expecting significant CapEx growth next year, but that's not spooking investors. Plus, more good news for the market from Qualcomm. The company's shares getting a boost after upbeat guidance for the upcoming fiscal fourth quarter. Qualcomm also continuing a trend from the past few quarters, yet again beating on the top and bottom line. And a rate cut is on the table in September, according to Fed Chair Jerome Powell, the head of the Federal Reserve, speaking in a press conference after officials left rates unchanged at a July meeting. The increased likelihood of a September cut sent stocks jumping to session highs during the presser, though Powell cautioned there is much more data between then and now. Well, U.S. stocks ending the day higher with a tech revival and Powell pointing to a possible September rate cut. Here with the trading day takeaways, let's get to Yahoo Finance's Josh Schaefer. Hey, Josh.
Hey, Julie. Yeah, we got to start with that tech revival today because that really was the highlight of the market long before Federal Reserve Chair Jerome Powell started talking. We had the NASDAQ up almost 3% going into the decision. Then we saw a little bit of a rally out of the decision. So let's just take a look at sort of what we had in that market action today. And overall, it was tech, and it was really, I can't stop looking at the big green for Nvidia, right? Up over 12%. And Nvidia started moving higher last night, Julie. I took a look at the stock sometime around, I think it was around 8 p.m., seeing how it moved after AMD, right? And it was up maybe 3% after hours. I woke up this morning, there's a note from Morgan Stanley out calling it a top pick again, saying after a 25% drawdown, maybe now's a good time to buy in.
Yes.
Then the stock's up 6 or 7%. And the gains sort of just extrapolated throughout the day. I think one of the broader takeaways for me here was it just felt like a little bit of a sentiment shift for big tech over this drawdown over the last month. It didn't seem like there was a lot of people saying the unwinding's unnecessary. I'm a buyer here. It's time to get back in here. This felt like one of the first bigger calls of, okay, maybe we've sold enough, and I'm starting to get interested in where the stock is trading.
Right, but then when it bounces 13%, do you have to revisit that? One of the most interesting points that I thought Joseph Moore made in that Morgan Stanley note, he addressed the issue of competition because there's been concern that some of Nvidia's competitors are coming out with their own chips. He said his channel checks are indicating that in some cases, companies are placing orders for those competitor chips and then saying, no, this isn't what we wanted, and going back to Nvidia, which I thought was a really fascinating point.
It is an interesting point, and something that we're still going to hear more about at the end of the month, right? That's the thing I keep coming back to with Nvidia is we look at all these other chip earnings to learn something about this company, but we know based on the last couple of earnings reports, they're usually telling us something a little bit different in some way than what people have been expecting.
Yes.
So I think we're still a little bit of a wait and see overall on where that story sits.
Yeah.
But I want to flip back to our second takeaway.
Okay.
Of course, I skipped Powell, right? On Fed Day, we went tech first.
You went straight to tech.
We
Wow.
went tech first.
Bold.
But one thing that stuck out to me from what Fed Chair Powell said, of course, he sort of said that September rate cut is, quote, on the table. That was kind of the key takeaway, I think, for markets. But he used this broad disinflation term in talking about inflation trends looking better this year than they did when we had inflation coming down last year. And we had a chart in our Yahoo Finance chart book that highlights part of what he was talking about. He was talking about services inflation, rent inflation specifically at one point in housing services. And you see this decline right here is really part of what he was highlighting.
And that's something that the Fed and economists have been waiting for.
Right. You were waiting for this Zillow observed rent line that came down already a little bit. The blue and red lines hadn't followed that. And the question was, we know eventually it's going to happen, but at what point is it going to happen? And in the most recent inflation data, we started to see that. And I should point out the Deutsche Bank economist, Brett Ryan, that sent this chart to us, said he felt like this was the game changer for them to see a September cut because he noted that once rent inflation starts falling, it's usually a pretty sticky trend, so it makes them feel more confident in the overall trajectory.
And of course, the Fed is watching that closely, but we've also been watching what companies have been saying. And when you get some of the consumer staples companies, for example, that had been seeing that inflationary tailwind for so long, the likes of PG&E and Kimberly-Clark now talking about that they're not able to raise prices in the same way. You see a lot of other types of companies talking about promotions and sales. So you get that part of the disinflationary trend too.
Brings us to the point where you wonder, why didn't they cut today, right? Which I think some of the reporters asked, but when you put together the totality of the inflation data, it seemed like more of this is what will get us to that September cut.
More good data.
All right, our final takeaway, I added this one after hours for us because I did, of course, find the Meta earnings that just came out rather interesting. So it was our fourth Mag 7 company if we want to keep grouping them together. And I'm going to sort of make the case here for why we should stop doing that. I feel like the takeaway from the first three earnings that we had, specifically maybe Microsoft and Alphabet, was, okay, we're continuing to spend on AI. We're not seeing enough payback on that spend for AI. When you look at what Meta just told us after hours, is they're continuing to spend very aggressively on AI. They have a better way to show you what that spending is doing. And it seems like overall, at least in early after hours action, that's helping the stock. It's a little bit of a different story than what we were hearing otherwise.
Yeah.
I hit the extended board for us here.
Oh, there we go.
Oh, and I undid it.
Too many times.
We got to get the Meta.
So Meta's up 4%
We're
right
up
now.
about 4%. It was up as much as 8%.
Nvidia's still up in after hours after rising 13% today. There you go.
We're back. We're back to the tech rally.
We're back to the
couple
tech
weeks
rally.
off, and we're back to tech all the time.
Thanks, Josh. Speaking of tech all the time, we're going to keep talking about tech here because while investors were disappointed with Microsoft's AI software sales, they cheered AMD's chip sales. It's the story of two sides of the AI trade. And joining us now with more on this, Yahoo Finance's Dan Howley. So what are these two sides? Walk us through it, Dan.
Yeah, Julie. So let's start with the Microsoft side. They had better than expected earnings and revenue for the quarter, but the cloud, the intelligent cloud, missed slightly, and nestled in the intelligent cloud is the Azure revenue for Microsoft for every quarter. Now, that's a big deal because everybody looks at Azure revenue. They don't, by the way, break out Azure on itself. They put it in this kind of Azure and services, but I digress. What they missed there was an opportunity to really blow away Wall Street. And clearly, the question that was on everyone's mind, at least on the earnings call, was when are you going to start making some money on all of this investment that you've been doing in AI infrastructure? And the long and short of it was Amy Hood basically saying, CFO, look, this is for the next 15 plus years that we're pouring this money in. That didn't really soothe any kind of nerves with Microsoft. So you saw them drop about 7% immediately following the report. Then throughout the day today, it was around 1% they were off. On the flip side, we have AMD, which did extremely well, beat on the top and bottom line, and also beat on their data center revenue. That's where they sell the CPUs and GPUs that power AI servers. They also said that they expect to see better than expected revenue from the data center in the coming quarter. People jumped all over that. We saw shares jump immediately after the report and then throughout the day today. And oh, by the way, that also helped that little Nvidia rally that we saw today, kind of a knock-on effect. People are likely figuring, well, if AMD did well, then Nvidia must have done great. One of the other things worth pointing out is that Microsoft made sure to let people know that they're going to continue to spend on infrastructure going forward. Again, that's the big question, when's the money going to come from? But that in and of itself, that statement, could have also helped AMD because AMD's chips are what help power, or at least partially AMD's chips, are what help power Microsoft's Azure and AI capabilities. So it's kind of, this one side doing so well because the other side is spending so much. Meanwhile, the side that's spending so much is getting smacked around because people are saying, when are you going to start making money on all this?
And then there's Meta.
Yeah.
So, which is so interesting, right? Because it's also spending money on this. But maybe, as we heard from Rohit Kulkarni a little earlier, maybe they've communicated better with what they're getting out of it?
Yeah, I think, what's interesting with Meta is they have open source AI, so they can still license that, right, out to enterprises, make money on that. They want a large spread adoption of it because then more people are building on their capabilities. As far as the spending goes, we just saw them say now, right? This is Q2 of 24. They're saying that they expect to see significant capital expenditure growth in 2025. So they really are telegraphing this way in advance. And obviously, kind of what you're alluding to is they're getting people ready to say, look, we are going to be spending. We're spending now. I think they said between 96 and 99 billion of expenses this year. They told investors that last quarter. That remains unchanged. So they'll go from 96 to 99 in there. That's what they're going to spend while they build out. But then, significant. What does that mean beyond $99 billion, right? Yeah. So, I mean, I think for Meta, it really is, like you said, they're messaging it, they're massaging it a little more, and investors may like that. I think also one of the things is, Meta is obviously a massive company. They're building AI into everything, right? They want to offer it as a product for everyone. Microsoft, however, has to run the cloud. It has to build these models. It has to offer these models, a litany of them. They're also powering OpenAI with Azure. So you got to wonder how much more they're going to spend than Meta in the long run.
That's a good question. Thanks, Dan Halley.
For sure.
Appreciate it. Well, recently, as major chip makers like Nvidia have gone, so has the NASDAQ. Today's no different. Semiconductors leading the exchange's surge. Joining us now with more is Patrick Moorhead, More Insight Strategy founder, CEO, and chief analyst. Patrick, so now we've gotten a bunch of these companies to report. You just heard the conversation with Dan Halley. What have we learned about where we are in this AI build-out cycle?
Yeah, so first and foremost, you have the infrastructure providers. That includes the chip companies, but also the infrastructure as a service providers. And the names behind them, people are looking for any hiccup that's out there, because the gains have been so big in names like Nvidia and AMD and Broadcom. They're looking for anything that might portend to the downturn. And then another positive data point comes out and everybody just jumps back on the train. Last week, I was on one of your shows and I really laid out a thesis that says the infrastructure build out is going to continue for at least another year and maybe 18 months. And that's driven primarily by the downstream FOMO, or the fear of missing out from those enterprise SaaS providers. Meta, who clearly showed that they're investing hardcore because they have to. If you are not investing and your competitors are, you could be set back potentially a decade here. Now, in the long run, of course, the downstream value has to be there, and I am looking to the enterprise software makers, names like ServiceNow and SAP and Salesforce. And I'm also looking at the second tier of what I call AI infrastructure, which we discussed a little in relation to Qualcomm, and ARM even printed today, is the smartphone and AI PC boom that I believe is coming up shortly.
And when you talk about some of those ServiceNow and some of the other enterprise software companies, what are the early indications of that ROI that they're getting?
Yeah, so the early indications, when the companies actually will directly talk about it, because not everybody is. For instance, Adobe isn't being very clear on it. I believe ServiceNow is, and Salesforce is as well. And even SAP's Christian Klein did the drill down. With customers who are implementing, they are seeing some pretty staggeringly impressive results, like 50% improvement in productivity, 20% increase in the amount of stickiness and revenue that they can drive with certain customers online. The challenge now is to get more people doing more, getting them beyond these POCs or trials and rolling it out to the masses. We know that enterprises are typically slower than, let's say, consumers. And then the other side of that is, because you brought up Apple, right? With what we've seen and what they're bringing out with Apple AI. And that in itself could drive a massive run in everything related to AI. And on the Qualcomm discussion that I actually had with Cristiano Amon, the CEO of Qualcomm today, He really talked about the next generation of AI smartphones. For instance, putting in this new Orion CPU that boosts performance, boosts AI performance. So it's happening. I am seeing indicators that the downstream effects are going to be there, but we do need to see acceleration over the next 6 months, or I think people are going to get very edgy.
Patrick, and it's interesting to hear you talk about the likes of ServiceNow talking about the effects this is having on productivity, because then you hear this Upwork study that showed the people who are using this stuff in their work didn't like it. They feel it's not making them more productive, and they're having to correct mistakes. And I wonder what the risk is that there is going to be this bias on the part of these enterprises. I've made this huge investment. I have to make it work, even if it's not working. Is that a risk here?
I think it's always a risk with new technology. I mean, if we looked at PCs, we looked at smartphones, we looked at enterprise SaaS software, it does take a while, and there have been some fits and starts. The tech industry and enterprises have this amazing coalescing capability, because you have very motivated parties to make this work. And the great part about enterprise SaaS companies is they can make very quick changes to all this. What the biggest thing that's taken so much time here has been getting the data estates in line, because unlike any other big tech thing we've seen, and even though garbage in, garbage out, and the data has always mattered, it matters even more with generative AI. The upside is there for the productivity, but also the downside and risk from a security and complexity and privacy point of view. But I have confidence that in the next 6 months, the industry will be in a very good place downstream.
Patrick, I want to circle back to where we began, and that's with the chips, because I got to ask you about Nvidia. As Josh likes to joke, we're contractually obligated in every conversation to mention Nvidia. Not really, but it feels like it. And obviously, it saw a big surge today on that, the catalyst of that note from Morgan Stanley. We have to wait until the end of August to get those numbers. Do you think once again that the highest estimates will be blown away?
Listen, I'm sticking to my guns here, and that is that Nvidia has at least another 12 months to run. We saw TSMC, where Nvidia does all of their manufacturing. They're basically sold out through 2025 and into 2026. We just heard from Microsoft and Meta that they're putting the pedal to the metal on this, and all of this is goodness for Nvidia. And by the way, it's good for AMD, and it's good for Broadcom and Marvell as well.
Patrick, always great to see you. Thanks a lot. Appreciate it.
Thanks.
Stick around. We got more Asking for a Trend on the other side. The labor market in focus as recent headlines suggest more weakening. Reports saying Intel, for example, limiting thousands of jobs, and Disney is planning a fresh round of job cuts in its TV division. Video game studio Bungie announcing today it's laying off 17% of its workforce, adding to an industry that's already been decimated by layoffs. And this is the backdrop the Fed is facing as the central bank acknowledged there are risks to both sides of the dual mandate, including employment. Joining us now, Julia Pollack, chief economist at ZipRecruiter. Julia, it's good to see you. And of course, we've got the jobs report on Friday. We had JOLTS and ADP already this week. How would you characterize, I mean, we're always going to have these anecdotal examples, but how would you characterize the job market overall right now?
So Fed Chair Powell today said that the labor market was coming back into the pre-pandemic normal levels of activity. And I would argue that outside of government and healthcare, so if you just look at private sector job growth, excluding healthcare, the labor market is actually much weaker already. Job growth over the last 3 months has averaged just 58,000 jobs a month in sectors that used to average 137,000 jobs a month between 2015 and 2019. So job growth outside of healthcare and government is actually 60% slower than was normal before the pandemic. And that's why I think anecdotally you're hearing from job seekers and employers that the things are not going so well in the labor market.
Yeah, and one of the other charts that stood out to us from ADP was the differential between people who stay at a job to people who switch jobs in terms of the wage boost that they get. And that gap has really been closing. In other words, it doesn't pay to switch your job. What does that imply about the tightness or looseness, I guess, of the job market right now?
Sure. And so the labor market is slacker now than it was before the pandemic. We have just 1.2 openings per unemployed person, slightly fewer than before the pandemic. The reason there's so little hiring happening right now, the reason the hires rate is actually the lowest it's been since 2014, since the labor market was still sort of sluggishly recovering from the Great Recession, is that companies are not thinking of this as a good moment to expand. They are, in fact, giving up great opportunities to expand because the cost of finance, the cost of credit is just too high with these rates. Rates are really restricting a lot of activity right now. And so this is sort of a missed opportunity labor market.
Julia, do you think that the Fed should have cut today?
I think so. I mean, the Fed Chair Powell said that inflation was still somewhat elevated. Well, the New York Fed's measure of underlying inflation, its multivariate core trend inflation measure to be precise, is 2.06%. That is basically right on target. So arguably, our work on inflation is done and the labor market is weakening. And if rates were slightly less restrictive, perhaps we could have a situation where inflation was stable and also where the unemployment rate was no longer ticking upwards and hiring was no longer slowing and job openings were no longer falling. And that, I think, would be a better place.
Well, we'll see if they do cut in September and that becomes the scenario at that point. Julia, thank you so much. Appreciate it.
Thank you, Julie.
Time now for what to watch. There are 2 more Magnificent 7 companies reporting after the close. That will be Apple and Amazon, plus Intel and Snap are also on deck. Apple will announce its third quarter results after the close. Analysts expect iPhone sales to finally start stabilizing in China and for the company to meet third quarter expectations. There'll be plenty to consider ahead of the opening bell, too. Among the names reporting in the morning, AB InBev, Shell, and Cigna. Anheuser-Busch reporting the second quarter earnings before the bell tomorrow. The beer company's volume expected to improve, while profit will be under pressure, according to analysts. And finally, Freddie Mac releasing updated mortgage rate data last week. Rates held relatively steady, increasing slightly to 6.78%. Well, coming up, I'll get you caught up on a few more earnings that have stocks buzzing after hours. Stay with us. Let's take a look at what is trending after hours. Start with Carvana. Those shares are surging after the company topped Wall Street estimates for the second quarter. The used car retailer delivering a surprise profit with an earnings per share of 14 cents. That's compared to the expected loss per share of 9 cents. Carvana's retail vehicle unit sales and gross profit per unit also topping the street's expectations. We're also looking at shares of Etsy. Those shares little changed at the moment after the company's second quarter revenue topped estimates, though the number of active buyers came in lower than expected. The company also expecting that gross merchandise sales in the upcoming quarter will decline on a year-over-year basis. And Etsy announcing its chief financial officer, Rachel Glazer, will step down after more than 7 years in that role. By the way, we'll be speaking with the CEO of Etsy, Josh Silverman, tomorrow in our 3 p.m. Eastern hour for more on those Etsy numbers. Teladoc shares also on the list here. They are sinking after second quarter results. Revenue missed estimates as the company notes continued headwinds in the BetterHelp segment. Teladoc also withdrawing its full-year financial outlook for consolidated operations and for that BetterHelp business. The shares down 12%. Well, that's a wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.